Hey, how you doing? It's Clayton Teeny from the First Home Buyer Club. 100 lessons in 100 days, day 84, lesson 84. Today, what I want to talk about is interest rates. What's the differences between them all? What's all the jargon mean and what you really should be looking for? So firstly, I should always start this lesson like I do normally and say, I'm not giving you financial advice. However, this is lessons I've learned with both finance and my own property experiences over nearly 20 years now, and through learning myself or learning through friends, mentors, or other professionals that I want to pass on. So a couple of things I want to talk about today. What is the difference between a cash rate and an interest rate? And if, the RBA's lowered the cash rate, how come it doesn't align with the interest rate? Well, here's the thing with the cash rate, right? Obviously, the cash rate is really low at the moment, but the banks still need to borrow that money to then lend it to you. So as a result, there's always going to be a margin on it because business, just the same as, where you work and everything else, are in it to make money, right? There's always going to be that little bit of a buffer. Will we see negative interest rates over the next, 2, 3, 4, 5 years? I'm not quite sure. But the lower the interest rates get, the cheaper the money is. And the cheaper the money is, it's the faster that you're going to pay it off. So really, as long as you keep the job, it's a win-win. All right, here's a couple of things I want to chat about today, especially with the interest rates. Obviously, you've got the variable rate and the fixed rate. Now, everyone asks me, Clayton, what would you do in current circumstances? And there's no right or wrong answer because it'll depend on you and not me, right? So for me personally, I haven't fixed an interest rate since I was about, my first home loan. I fixed the first one for the first 2 years. So it would have been 21 to 23, 20 to 22, somewhere around there. So it was a good 15, 16 years ago. And the reason why I did it was because I wanted to know that each week I knew exactly what I was going to have to pay. Now, for your first home, you always want to get your bearings and you don't want to be in a stressful position when you are looking at purchasing a home or having a home. So at that point in my life, I felt comfortable getting a fixed interest rate and knowing guaranteed that I could do a certain amount. I also knew this, that with my bank at that point, I could pay an extra $10,000 a year on top of my minimum repay or my maximum repayments to bring it up to that extra 10, and that was going to be enough. Now, for me, I was not in a position where I wanted to put in more than $10,000 a year on my property at that point in my life. So for me, fixed rate worked perfectly. When are other times that a fixed rate's really good? Obviously, the rates are really low now. There are some as low as 1.9 or something like that. I'm hearing on the news and seeing online these days, but most of them are sitting in the twos. Now, when would be the perfect time to fix a rate? In my opinion, if I had 30, 40, 50 grand in personal loans and debts, it'd probably be an amazing time to fix your rate and work off smashing off those other loans. Why? Because your car loan might be at 6, 7, 8, 9%. Your personal loan might be at 15 to 20%. They are major differences to the 2% that you might be able to fix your home loan, 2 or 3%. So in times like that, when you have a lot of personal debt, or you and your partner have a lot of personal debt, or they have personal debt and you don't, where whatever it is, it's not a him or her, because obviously you're a partnership, and if we're planning on life together, we need to work with it together. That's a good time when you want to fix the rates, because you can work off putting all your extra money into these other debts and paying them down faster. Because here's the thing, think about this. You might have $50,000 combined in personal debts. That might be costing you anywhere between $1,000 to $1,200 per month just to pay them down. Now, if you contribute an extra, $300 or $400 a week, you might have all those debts paid off for the next 12 to 24 months, which means then you've got another $12,000 to $15,000 each year you can invest back in your mortgage, into another investment opportunity, or other choices in life, because making money and creating wealth is just so you've got more choices in life. Creating wealth isn't about sitting at home locked to the TV and the couch and never being able to live life. It's about having more money, having more choices in life to live it. Because at the end of the day, that's all we want, right? More choices. And the more money we have, the more choices we have. All right, with interest rates versus comparison rates, you'll see it a lot online and a lot on the TVs because the banks have to list this. You might see one bank offering an interest rate of 2.09, but the comparison rate is 3.4. Now you might try and get that against a second bank that has 2.75, yet the comparison rate is only 2.77. And you think to yourself, well, this one at 2.14, that's the deal. It's way lower. But what you need to make sure when you're understanding this interest rate versus comparison rate is a comparison rate is that current interest rate that you're looking at, plus adding on any fees and charges that may go along with it. So whilst it might be 2.09, they've got bank fees and account fees and all these other costs associated just to have that home loan that then is going to drag it out and takes it over that other point. So you need to have a look at the comparison rates and really make that decision. Are you making the best choice? Now, here's the thing that is always going to throw it out. If you have a fixed rate, the comparison rate is always going to be higher, and you're going to go, I don't understand. How does that work? Because let's say you fix the rate over 3 years, that might have the 2.1% fixed rate for 3 years, but then you'll see the normal bank interest rate, even though you can get it at 2, it might be advertised at 4.5. So you'll always see these discounted rates online, and then their standard go-to, if you don't ever ask for another discount, is going to be that higher rate. Now, be aware of this and understand this. The bank is in the game of making money. So don't get upset at them when they don't ring you up every 12 months and go, hey, I've got a way for you to save another $50 a week on your home loan. Are you interested? Because they're in the game of making money. So what you have to do every 12 months is you have to ring them up and talk to them about what better rates can they give you, what other options have you got available to you based off what you owe, how much equity you've got. You'll find that the banks will always want to try and keep your business unless they can't, right? So that's the other thing you need to do is do a bit of research and understand, are you in the right bank? 2, 3, 4, 5 years goes down along the line and you've built up quite a bit of equity. You might even have 20% equity by now. So now you don't have to worry about paying mortgage insurance if you switch banks. Once you have 20% equity in your home, no more mortgage insurance. So it's one less thing you've got to worry about. Then you just have to shop around and go, hey, are they giving you the best rate possible? Don't be loyal to the bank, because at the end of the day, they're not loyal to you. They're loyal to the money that you provide them. Now, they'll give you good service, hopefully, touch wood. But at the end of the day, they're just there as a business to make money, and they'll do what's required. They don't want to put you in hardship. They're not trying to rip you off, but they are trying to make money. You need to understand that. Especially when you get 20%, shop around, see what's available. If you have a home loan at the moment, the other thing you should be looking at is what other banks are offering what interest rates, and are any of them offering you an incentive to jump across to them? Because there's a lot of banks right now that are doing refi bonuses, where if they refinance your home loan, they'll give you $2,000, $3,000, $4,000, whatever it is. It could be a lucrative way to jump across. And then especially on top of that, if those banks waive the sign-up fee and the start fee to come across to them, and you don't have to make mortgage insurance, you might be saving yourself 0.5% on the interest rate, plus getting a cash bonus just for switching. Have a look around, make sure you know what you're doing and what's the right choice. The other thing with comparison rate is, obviously, as I spoke about before with the fixed rates, it's going to be off. Understand that. So you're going to have to ring them up and ask the questions. If you fix a rate, what are the other fees that go along with that account? And make sure, tweak the numbers and make sure. But, there's some massive variances at the moment between fixed and variable rates, depending on which bank you go to. There may be an amazing opportunity where you can get a whole heap of interest knocked off your loan and save a lot of money. But if you're going to fix, find out what's the maximum amount you can contribute above the minimum repayments before you get penalized, and see does that work out with you. Do you only want to do that amount or not? And if you don't have any debts, then maybe variable's the way, or you fix most of it or part of it and keep the other part variable and just smash down the variable part of the loan so you can help yourself pay off the home faster. Now, again, if you're looking at buying another property or investing in the next 2 to 3 to 4 years, you want to throw all your money into the variable, into the offset account, not into the loan, so that if you use the house you're currently living as an investment property, you'll get more negative gearing and more tax depreciation when you claim on tax time. The second thing I want to talk about, and I've spoken a little bit about the interest rates. Me personally, I haven't fixed it for years, but you've got to do what's comfortable. Also, with whatever you decide, create that plan, right? If you want to create the plan, I want to be mortgage free in 10 years, or I want to be mortgage free in 15 years. Understand that and make the plan around it. Don't just hope, because it's the easiest way not to get there. The other thing, and I was reading a good book recently, The Road Less Stupid by 𝐫𝐞𝐚𝐥𝐿. And one part I loved out of the message that was coming out of it was that really life's just about, well, he refers to business, right? His choice in business, but business is all about making the less mistakes or stupid decisions possible to get to the end. Because, and I'll quote what he said here. I really liked it. He goes, we've mistakenly always been taught the higher the risk, the higher reward, which I'll agree. You always think that, right? The higher the risk, the higher reward. But he actually references it to the fact that really the higher the risk, the higher the likelihood of loss. And that's not reward. And so, it makes up a good point. And I have reflected my own investment choices when I was young. And I spent 3 months in Iraq when I was in the army, and decided I'd invest on a gold warrant. Now, unfortunately for me, I just rushed out, invested in a gold warrant for 3 months, and it really was just gambling. And at the end of the day, I look back and I'm like, man, I shouldn't have done that. And I know whenever I invest in something I don't understand, I always tend to lose money. And so if I use the principles from the book, what he talks about, I shouldn't have done that, because it was just a stupid decision. And whilst I was thinking, man, I can make 30 grand easily within a couple of months, just like that, I lost it. And at the end of the day, 3 months in Iraq working for nothing was definitely not worth it. So really limit the dumb mistakes you can make in life. Don't get too caught up on fixed or variable rates and make it a stressful occurrence, right? Because at the end of the day, yes, you may save money either way, but you're already in position to comfortably pay that off. You need to make sure you're not making the dumb mistakes along life where you can lose it all. Like me, right? 30 grand, it's a big chunk. It was actually 3 months in Iraq. The first half of the trip, I lost it. It was like I worked for free. All right. The other thing, and the last bit I'm going to talk about here, is really because we're always wanting to make more and more money and invest smartly and do all those things, but we've just got to find that middle point between greedy and just sitting on the couch. And because at the end of the day, we all want to make a heap of money and really live life on our terms, but we lose a lot when we risk the most. So just find that point where you're making the smart decisions to make money without having to panic one day that you're going to lose 20, 30, 40, 50 grand. All right, guys, hope you had a great weekend. Obviously, it's heating up, so I can feel myself sweating already. Talk to you some more tomorrow. See you later. Bye.